Hello, you're listening to Leisure World Direct. My name is Emma DiMaggio, Communications Manager for the Golden Rain Foundation, and I'm joined by Golden Rain Foundation Executive Director Jessica Sedgwick and Executive Manager of Mutual Services Dave Potter. Hello.
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 Today's topic is insurance rates. The 2025 budget was passed, and rising insurance costs definitely made their impact on that budget. We'll jump right in. Why did the rates go up?
Insurance rates went up because if you look at the market for California insurance right now, insurance carriers are raising rates pretty much across the board for every class of insurance customer in the state of California. I know I myself, on a property I own, my insurance rates went up 70% year over year. And I've had that policy with that carrier for over 20 years, and I have never filed a claim with that carrier. And when I asked the carrier about it, I was informed that I was lucky the policy wasn't canceled. So it's an unfortunate fact that because we've had so many large claim year histories in California over the last 4 or 5 years, it's forcing the insurance carriers to up those rates so that they can still have the necessary funds to make the payouts that they need to when claims come in.
How much did the insurance go up?
So to talk about it monolithically as though it's the insurance, when the reality is that it's multiple lines of different coverage for different events, and in some instances you have multiple carriers giving layers of coverage to provide a higher amount of coverage to you rather than simply having one carrier that gives you the single rate. The rates went up, the package cost went up, I think, around total, somewhere around 40 to 50% for the 2024 renewal. And then they went up within budget parameters. It was a much lower budget parameter of about 10 to 15% for the 2025 renewal. The 2024 renewal was not forecasted for, which is why it had such an adverse impact on that 2024 budget. The 2025 increase was successfully forecasted and planned for. So we are not anticipating a negative reaction on the budget. Perhaps it'll happen when we get to the 2026 renewal, but we'll see.
You spoke about layers of insurance. Can you kind of go over what sorts of insurance GRF carries and what sorts of things they cover?
So obviously, GRF carries property insurance for both itself and the mutuals. And again, it gets challenging to refer to the insurance, and I'm using air quotes around that for those of you who are listening and not able to see us here in our recording studio. The insurance is a broad package of a lot of lines of coverage, and it is for both Golden Rain Foundation and for all of the mutuals. So we have kind of aggregated all the different businesses here, all the potential clients into one package cost, and that is done to reduce the overall cost for everybody here. So there's a property insurance package that covers both GRF property and mutual property. There is liability insurance for both Golden Rain Foundation and for the mutuals. There's directors and officers insurance for Golden Rain Foundation and for the mutuals. Then you start to get into a lot of, I'm going to call them smaller lines and more specific or exotic lines of insurance. There's pollution insurance. That exists because Golden Rain Foundation maintains its own fleet. We have a bus fleet. We have vehicles that the security uses. We have vehicles that our service maintenance team uses. And we maintain fuel for those. And we have fuel tanks on site. So we have pollution insurance in the event that something happens and there's a fuel spill that causes contamination into the environment. There's active shooter coverage.
Yep, we have active shooter coverage. We also have cybersecurity coverage for both the mutuals and for GRF. And then specifically to GRF, we also have an errors and omissions policy because we have employees.
And employees are human beings, and human beings do make mistakes, even the really good ones.
So we have all these levels of coverage in GRF, and the increases were caused by increasing disasters, of which, earlier in the year we had the fires nearby, which kind of prove that they're continuing.
Yes, and I was going to say, so the fires that happened up in Los Angeles County, which I'm sure are first and foremost on everybody's minds, those happened after the GRF policy renewed, So the impact of that truly historic loss, and that'll be historic not just for California, but frankly for the United States as a whole, the impact of that loss will not be felt until later this year or perhaps even the beginning of this year, just because of the timing of how reinsurance markets bid their coverage out. In reinsurance, if I'm going to oversimplify it to the point of being wrong, reinsurance is the type of coverage that insurance companies purchase to help them out in the event that their models and forecasted for loss histories go awry and they have to pay out more than they expect.
And a lot of these increases that we're seeing too is because we've had year over year of really, really high insurance losses, not just in California, but nationwide and around the world as well. I can't remember what our broker said, but it was something along the lines of just over billions in losses, probably 20 billion in losses over the last, every year for the last 5 years.
And that's statewide, that's not GRF specific, just to be
one's
clear.
statewide, yeah. That is not for just GRF. We have not had $20 billion in losses. And things like the floods in Spain will affect the reinsurance market, will in turn affect our rates. So a lot of times it's not about what we are doing here, but what's going on statewide, nationwide, and globally.
If I can shift back to 2024, because I think that a lot of residents who think about insurance are kind of thinking about the 2024 insurance cost because that's what they saw in their assessments. Can you explain to me, because it was unexpected, how did GRF account for that expense in the budget process?
So the problem was that it wasn't accounted for in the budget process, right? And I wasn't here for the 2024 budget process, so I have pieced this together after the fact, not through my own firsthand experience. But the broker looked at things historically and said, here's how the insurance policy, the insurance package has risen in cost on average over the last 5 to 6 years. And even though the market had been worsening in California for some time, our broker had always been very successful at keeping the increase for GRF below what the market was doing. And they were confident that they could do that again, that string would continue. Budget process was completed using that forecast. Frankly, the forecast was a little higher than what they were anticipating. And then the wheels kind of fell off the wagon and the luck ran out and the market caught up to us. So the increase was substantially more than what was forecasted. How GRF accounted for that was basically tightening on spending wherever possible and looking to flex and increase revenue wherever possible as well. We were largely successful about that. I mean, we made it through the year. We didn't have to do a special assessment on anybody. But at some point, that money does come due. And that was part of what drove the increase then for 2025, is we have to account for not just that unanticipated increase in cost in 2024, but now we have to account for what we're forecasting will be the additional increase in 2025. And oh, by the way, we've got to plan and financially prepare so that we can start to make these larger down payments in the month of December when the policy initially renews. So all that kind of consolidated together to drive what was the vast majority of the 2025 increase. If you take insurance out of the equation, I think the budget would have only increased about 2% year over year from 2024 to 2025.
That's right. The majority of our budget increase for 2025, the assessment increase, was insurance.
What are the challenges of accounting for the insurance rates in the budget in terms of timing? I know that there's you're predicting
Yes.
what it's going to be in this weird sort of market. What are the timing challenges to predict kind of an accurate, why can't they just tell you how much it's going to cost and then you put it in the budget ahead of time, is what people might be thinking.
It has to do with the overlying of what are the statutory requirements for Golden Rain Foundation and all the mutuals as common interest developments. The law states here when you have to tell members what the budget is going to be for the next fiscal year. And that law says you have to notify them at, no less than 30 days prior to the start of the new fiscal year. Fiscal year here starts January 1 for everybody, so that means the mailer has to be postmarked before November 30th. The mailer is, again, by law, required to have all kinds of information in it beyond just the budget. So the logistics of actually compiling it, putting it together, and getting it printed and then to the post office takes a substantial amount of time. So you really need to have the budgets approved in October, the month of October, so that you can spend November finalizing the preparation and getting everything out and hit your statutory deadline. The challenge that creates is that the insurance policy, that package that I keep talking about, put the insurance in quotes again, that has a renewal date of December 1st. And most insurance carriers, will not even give you a quote until 30 days before the renewal term. So November 1st is the earliest you can expect to get a meaningful quote from the carriers on what the policies and the package are going to align to be for Golden Rain Foundation. And when the market is tight like this, the broker is going to be working with multiple carriers to try to get those costs down, negotiate the rates as well as they could, play carrier A off of carrier B, and you don't tend to finalize it until really right around Thanksgiving, which you're already at the point where the mailer is at the mailing house to go out at that point. So because of the timing, it's always a forecast model that we have to work off of and never the actual number. And that's where you can get caught in a bad situation like what happened with 2024.
You talked about planning for 2025. What, maybe simply financially, is the foundation doing to plan for 2025 and beyond?
So the method that we used for the 2025 budget was we put in some checkpoints with our insurance broker to get some feedback, like an advanced weather forecast, if you will, on how things are going. So when we start our internal budgeting process in July, that's our first checkpoint. They're able to tell us broadly what they're seeing in the market. No specifics for GRF yet, but they can say broadly based on the market, here's what we're anticipating the package would look like for your next renewal term. And that's the number we start our budgeting process with in July. July is also typically the month that they start doing their bid process. So it's a long process for the insurance brokers too, right? I talk about how we're going to renew in late November for starting the package December 1st. They start the process formally July 1 to go out and get bids. So then around September, we do another check-in, because now they've put the bids out in the marketplace and they're starting to get feedback, and they can start to give us some real specific numbers like, okay, here's what we thought the market was looking like, and here's what people are telling us specific to you and your situation at GRF. And then we revise the forecast up, or we revise the forecast down, or we keep it steady. And then we do that again in October as we just keep progressing through it. That model seemed to work a lot better this year because we hit the budget number. We're going to do it again for 2026. Hopefully that trend will continue.
Where is the money coming from if the insurance rates are going up, but they're not necessarily always hitting residents' assessments?
So in the event that the insurance, any budget item is higher than what it was, and it was easier to talk about this in a mutual situation, because the mutuals all got hit with the same thing too. Their insurance budget was blown away. They either absorbed the cost at a mutual level, or they did something to increase their revenue throughout the year, right? They would do a special assessment or something else to try to offset that unanticipated loss from insurance. That's what all the mutuals did. It's what GRF did too, but GRF has a lot more things going on than a mutual does. So I was in a mutual budget meeting, and we were talking through the increases in that insurance line item, and one of the shareholders actually stood up to speak out to some of the people who were there who were pushing back on why does it need to go up that much, to remind them all, hey, wait a minute, the mutual absorbed that loss for you this year on insurance, and they didn't come to you for a special assessment. They didn't do any of these things to try to increase the revenue. They just absorbed it. They took the loss on the books and paid for it out of cash that the mutual had on hand. They have to make that up at this point now. That's why you're seeing the larger jump on the in that particular mutual for that particular year, to make that up and try to rebuild some of those cash on hand back up.
What fund would that be? Cash on hand?
Operating.
Operating. Okay.
Good use of the word fund.
Just so people understand where it's, because I think there's just so much money floating around GRF that's allocated to all these different areas. So I think of a big bill like this. I know some people are paying, less than $100, less than $50 maybe in their assessment. But with a big bill, you never really know where it's coming from unless you're in the weeds or with the financial expert. Is there anything else that you think is important for people to understand or keep on their minds as we, in 2025 enter another budget year, another insurance situation, or even about insurance in the world?
One thing that I want to make clear, because I know there's some chatter, some misunderstanding about this out in the community. GRF has an insurance broker, and the insurance broker puts out a bid package to multiple carriers every year. So yes, when the renewal times comes, we talk to our one broker, and we don't need to talk to multiple brokers, because what the broker does is go out and talks to several dozen carriers. They get multiple bids and then filter through to find the one that makes the most financial sense and offers the most appropriate level of coverage that's needed for GRF and all of the mutuals here. So from the outside looking in, it may look like it's not a competitive bid process, because we'll go to these meetings and we'll say, and here's the bid, and up or down vote on this. That's because that moment that you see in the meeting where the bid is presented, we've gone through a multiple bid process already with the broker, and the broker has winnowed everything down to the package that you're going to see there. But there are literally, as part of the packet that they give to the board, a list of a couple of dozen carriers that either supplied a bid that wasn't selected or that declined to bid outright.
At least several dozen, if not more.
Who just don't want to provide.
You'll get quite a few that just decline to quote for various reasons, depending on our unique situation here. Some that come in very, very high that we don't even end up coming in to us, just because they are very much an outrageous quote that we're not going to be able to afford. But at least several dozen.
The broker is kind of like a negotiator on our behalf. Is that correct? I mean, they're soliciting bids and sorting through for what's reasonable and what's, as you say, Jessica, just completely out of this world, outrageous.
In terms of the renewal process, a negotiation is a big part of what they do. I wouldn't necessarily want to limit it to just that for what they do, but yes, that is a big part of what they do. Because like I said, if they get competing bids in, the more bids they get, the better it is for them to do their job, because carrier A may be offering something that would be very useful to GRF, but the cost may be more than carrier B over here. So they can try to leverage that off of each other to either get carrier B to offer the thing carrier A is without increasing the cost, or to get carrier A to come down on their cost to be equal to carrier B, and now that becomes more attractive because it's a better product offering at the same price.
Should people expect there to be more conversations of insurance during the 2025 budget cycle? And is there a way for them to get familiar with the insurance market or these kinds of decisions?
I'm going to check my magic 8-ball on the first question, and I'm going to shake it, and it says signs point to yes, that there will be more conversations on insurance as we go through 2025 and 2026. And in terms of people getting familiar with the insurance market, I would just encourage you to watch the news and see what's going on. It's very front of mind what's happening now. There has been reporting on State Farm, one of the prominent residential carriers, seeking an emergency rate increase because of the amount of payouts that they're anticipating making from the fires in Pacific Palisades and Altadena. And I believe the state denied that emergency request from watching the news. So I think it's possible State Farm may determine to stop writing new policies in the state of California. At some point, the carrier will say, wait, we're not able to make money here under the current rate structure or the current regulatory structure, and then they will just decline to do business in the state. Regulators don't want that, because you need a robust market to, for end users like GRF or for the individuals here to be able to purchase insurance.
Well, thank you both. And people can listen in more at the budget sessions coming up later this year. You are listening to Leisure World Direct.